Good morning. It is Friday, January 16th, 2026. If you're a student of free markets, look away. If you're a trader, wake up. We have officially entered the era of the command economy. President Trump didn't wait for the Fed to cut rates. He didn't wait for the bond vigilantes to capitulate. He just went to the market and bought $200 billion of mortgage bonds himself. Well, using Fannie and Freddie's checkbook. The result? Mortgage rates just collapsed to a three-year low of 6.06%. The housing market is being force-fed liquidity. But here is the conflict for today: the financial boom versus the consumer squeeze. While Goldman Sachs and Morgan Stanley are printing record profits on Wall Street, Main Street is in a brutal price war. Albertsons is getting crushed. Healthcare premiums are in the crosshairs. Wall Street is partying like it's 1999, but the grocery aisle looks like a battlefield. Who wins? The banks handling the money or the retailers fighting for the crumbs? This is the pre-market pulse. Let's see the chaos of the day. Deep Dive 1. The Financial Supercycle, GSMS, and the $10 trillion Club. Let's start with the lead, because the smart money just showed us their hand, and it is holding a royal flush. Yesterday, we saw the new titans of Wall Street report earnings, and the message was identical. The deal machine is back. First, Morgan Stanley. They didn't just beat earnings. They outlined a path to $10 trillion in client assets. CEO Ted Pick is calling for a sustained 20% plus return on tangible common equity, ROCE. Think about that. In a world where risk-free rates are 4%, Morgan Stanley is generating 20% returns on its own capital. They're capturing the wealth effect of this bull market perfectly. Then Goldman Sachs. David Solomon is pivoting. He's done with the consumer banking experiments. He's back to doing what Goldman does best: investment banking and asset management. They outlined a 5% annual fee-based inflow target. They are raising their dividend to $4.50. They are seeing capital markets momentum accelerate. The broadening narrative. This connects directly to a massive call from Bank of America's Jared Woodard this morning. He says 2026 isn't just about tech anymore. It's about broadening. Small caps, IWM, value, SPYV, and financials are joining the party. He points out that the real economy, consumption, corporate investment, is showing profound strength. The trade. If B of A is right, and the banks are right, you need to be overweight financials, XLF, and capital markets, KC. Why? Because when companies merge, IPO, or raise debt, Goldman and Morgan Stanley take the toll. And with Trump forcing rates down via the mortgage market, the velocity of money is about to explode. Don't fight the tape. The banks are the new leaders. Deep Dive 2. The deflationary pincer, grocery wars, and Trump care. Now, let's pivot to the conflict. If the banks are booming, why is the rest of the economy bleeding? We are seeing a brutal deflationary pincer squeezing two massive sectors: retail and healthcare. Front 1. The grocery wars. Morgan Stanley just dropped a bomb on the sector. They downgraded Albertsons, ACI, to underweight and slashed the price target by 30%. Why? Because Walmart and Amazon are going nuclear. Walmart is targeting 95% same-day delivery reach. Amazon is expanding fresh delivery. Albertsons is stuck in the middle, dependent on pharmacy sales, which are slowing and lacking the scale to fight a price war with the giants. The analyst, Simeon Gutman, says market share will erode further in 2026. The takeaway: the big get bigger. In a deflationary price war, you own the scale player like Walmart and Amazon. You sell the victim like Albertsons. Front 2. The healthcare shock. President Trump just unveiled his great healthcare plan. The headline? Lower drug prices and premiums. He wants to codify most favored nation clauses, meaning the U.S. pays the lowest price globally for drugs. He wants to ban kickbacks to pharmacy benefit managers, PBMs. He wants insurers to publish their denial rates in plain English. This is a direct attack on the margins of United Health, UNH, CVS Health, CVS, and Big Pharma like Eli Lilly, LLY. If you force price transparency and cut the middleman fees, profits shrink. Goldman Sachs already downgraded Moonlake, MLTX, to sell this morning on approval risks. The healthcare sector, XLV, is becoming a political punching bag. While financials benefit from deregulation, healthcare is getting re-regulated by populism. The macro connection. This is why the Fed Schmid is sounding the alarm. He says inflation is sticky, but Trump is trying to force prices down by decree, healthcare, and intervention mortgages. We are in a tug-of-war between the Fed, trying to cool the economy, and the White House, trying to reprice it. The silent mover. Gold is the real scoreboard. While everyone is watching the Dow hit new highs, a quiet revolution is happening in the commodities market. Gold is surging. Silver is near all-time highs. But copper just pulled back. Why the divergence? Goldman Sachs says the copper rally is done. They see prices falling to $11,000 because China demand is weak and inventories are rising. But Mermican Capital released a fascinating note today, arguing that gold is the only real scoreboard. Listen to this stat. Since October 2023, the S&P 500 is up 59% in nominal dollars. But in gold terms, the S&P 500 is actually down 33%. The dollar has lost 58% of its purchasing power in that time frame relative to gold. The signal. The market isn't going up because companies are 59% more valuable. It's going up because the denominator, the dollar, is crashing. Trump's $200 billion mortgage bond buy, that's inflationary. That devalues the currency. That is why gold is screaming. Investors are realizing that nominal highs are an illusion. If you want to protect your purchasing power, you need gold miners, GDX. Kinross Gold, KGC, just announced 3 new U.S. projects. Alamos Gold, AGI, hit record revenue despite missing production. The miners are printing cash at these levels. The silent mover is telling you to hedge the paper boom with hard assets. Let's translate the headlines into trades. 3 tickers. Rapid fire. Ticker 1. CLAC, KLA Verdict, bullish. Why? Wells Fargo just upgraded KLA and Lam Research, LRCX, to overweight. The thesis? WFE, wafer fab equipment, acceleration. AI demand is tightening the supply of logic and memory chips. Stifel forecasts 15% growth in equipment spending in 2026. You can't build the AI future without KLA's inspection machines. Target, $1,600. Ticker 2. ACI, Albertsons. Verdict, bearish. Why? The Morgan Stanley downgrade is brutal but accurate. They are squeezed between Walmart scale and the pharmacy slowdown. With 21% downside predicted and a grocery war heating up, this is dead money. Sell and rotate into Amazon. Ticker 3. Private sector OpenAI or Merge Labs. Verdict, watch the sector, ERKX or IBB. Why? OpenAI just invested in Merge Labs, a brain-computer interface startup. This is Sam Altman chasing Elon Musk's Neuralink. It signals that AI is moving from chatbots to biology. Watch biotechs using AI like Recursion, RxRx, or Schrödinger, SDGR. The convergence of AI and bio is the next megatrend. Here is your playbook for the next 24 hours. 1. Follow the fees. Financials are the leaders. GS and MS are buys on any dip. The capital markets are wide open. 2. Fade the retailers. Avoid ACI and traditional grocers. The deflationary pressure from Walmart is toxic. 3. Trust the gold. The Fed can't print gold. Trump can't buy gold bonds. It is the only honest asset left. Use the pullback in copper to buy more GLD. This is the pre-market pulse. The market is rigged, but if you know the rules, you can win. Trade safe.